Hello and a very good morning to all of you. We welcome you again as we bring you the third episode of this popular investor education and awareness initiative of Aditya Birla Mutual Fund in association with Outlook Money. I am Vishwa and it is a pleasure to be back as your host for the day. Most of you would agree that one's emotional and financial well-being are intrinsically linked. Being in a poor financial situation can cause stress and anxiety, which may impact one's emotional well-being. On the other hand, poor mental health can hinder one's ability to effectively manage their finances, impacting their financial well-being as well. So, in a time like today, when both these factors are being impacted by the coronavirus crisis and all that the pandemic has brought along with it, it is imperative to give special attention to your well being, both physical, both financial, and emotional. And to help you to do that in the best possible way and to guide you through this process of improving one's level of well being, we have with us some eminent personalities with extensive experience and expertise in the domain of financial as well as emotional well being. Our first guest is Mr. K.S. Rao, Head Investor Education and Distribution Development, Aditya Birla Sun Life Asset Management Company Limited. Mr. Rao, an alumnus of IIM Calcutta, has spent over 2 decades in the mutual fund industry, and in his current role, he leads his organization's efforts toward investor education. We are also joined by Mr. Amit Trivedi, author, speaker, trainer, and a blogger with over 26 years of professional experience in capital markets. As a trainer, he has trained over 83,000 participants through almost 1,300 workshops across 130 locations in the country. Both Mr. Rao and Mr. Trivedi have done extensive work in the area of investor education and have been with us throughout this journey of creating financial awareness through this webinar series. But today we are also joined by Professor Kavita Ranganathan, Associate Professor in the area of Finance and Strategy at TA Pi Management Institute. Her teaching and research interests are in the area of behavioral economics and finance. So without wasting any time, let's get straight into it. My first question is for Mr. Rao. Mr. Rao, how do you define financial well-being and how does it impact one's life?
Yeah, good morning to everyone. It's thanks Vishav for having me here. Indeed, it's great to be part of a eminent panel with Amit and Dr. Kavita. It's an honor to be there. And at Aditya Birla Sun Life Asset Management Company, it's a privilege to partner with Outlook Money during this webinar series and during these unprecedented times to help enable the investors to take informed investment decisions. Indeed, today's topic is one of such topic which enable us not about the markets but about the well-being. As you rightly said, Vishav, the financial well-being is interrelated to the broad well-being of life. In fact, there is a study conducted by Gallup some time back, which is conducted for over 2 million people. There are 2 million people who got interviewed, and across the world this is. And their findings on the well-being, it has been discussed. It's broadly categorized into 5. It is like, there is a career well-being and social well-being, financial well-being, emotional well-being, and the last one was the physical well-being. And incidentally, if we can look at all these 3, financial well-being and emotional well-being are interrelated to other 3. That way, it's holistically it will become total well-being of an individual. And since today's topic is on the financial wellness, I can say financial wellness is something, it's a state of healthy living, through the active pursuit of financial knowledge. And it's a planning, and it's something like a goal setting to live your best life. It is a holistic approach, and not only about money, but it's about the life. It is a holistic approach about money and living. And it's doing more of what you love and more of what brings you joy while managing your finances better. And financial well-being, I was doing some research around. It's broadly divided into 5 other elements which can make things little reasonable for the people to look their well-being better. The first one is how you can have a clear path to achieve your identifiable financial goals or financial objectives. And the second one is how one can control day-to-day finances. Third one, ability to absorb the shock. That's a current scenario of pandemic. We are all one kind of shock, how we can absorb that. And of course, fourth one is how you can evaluate the financial options available to you for investing. And the last one is anything you take a decision. I think Amit and me, we were working across over last 6 months on various webinars. I think today it's for me 99th webinar per se. All of us, we are making an effort to make it to give a clarity and security, to the people. And financial well-being is clarity and security to individual, to leave behind if something happens, so that people can live peacefully. Here, the goal is to achieve financial well-being, and it's a state of health being. I'll just sum it up in such a way, one's outlook in the life should be positive, and end of it, you should be satisfied the way you manage your money, and making better financial choices through the knowledge. That's what we imparting through Outlook Money today, and knowledge and planning. And when you can manage your money better, and you feel better about your finances, and you will gain sense of security, and that will give you a supporting on your psychological, mental and emotional well-being. I think your short question, I have a long answer for you.
Thank you so much. It's quite insightful, and as you rightly pointed out, all the different well-beings of a human are interrelated. So, Professor Kavita, since your expertise is on behavioral economics, I want to ask you, when it comes to specifically emotional and financial well-being, how are they related to each other? Are they co-dependent, or does one lead to the other?
Yeah, so first of all, thank you to Outlook Group and Aditya Birla Group, and Mr. Amit and Mr. Rao and Mr. Vishav for having this conversation. I think it's very important aspect in when we speak about financial literacy. Basically, going to your question, Vishav, let's take a step back and look at it more fundamentally, right? So, what are we talking about here? What are emotions? So if we were to describe ourselves as human beings, we know that emotions are an integral part of us. So if you remove emotions from a human being, you will be kind of reduced to, perhaps a set of rules of logic and probability, which has no passion, right? So emotions kind of give you passion, and passion allows you to act, right? So emotions are a very important part of our decision-making process. Now, why are these two considered different? These two constructs. So we're talking of financial well-being and emotional well-being. Why are these two constructs, first of all, considered different? I think it goes to economics and finance, like going back to 1800, 1900 traditions. So economics and finance, that's where we are trained, kind of considers emotional decision making as separate from rational decision making, right? Now the question is why was it that economics and finance did not accept or kind of involve emotions in decision making? The short answer to this would be that at one point of time, perhaps emotions could not be measured, or emotions could not be predicted. And as financial economists and economists, we are all obsessed with predictions, about making predictions in the future, right? So all of this goes back to our training in economics and finance, where emotions were not part of a rational decision-making process, right? But today, if you look at research in behavioral economics or finance, at least past 20 years, the most seminal work by Robert Shiller, which talks about greed and fear, and how about investor sentiment which rules financial markets, right? So the short answer to your question is that emotional well-being is not separate than financial well-being. Unless an investor is emotionally secure, emotionally satisfied, he will not be financially well off, especially when we want to think of well-being as an experience. As like Rao sir said, that it is an experience of happiness, it is an experience of prosperity, right? So unless you're emotionally secure, I don't think you will be able to achieve financial well-being.
Right. So you are saying that emotional well-being is precursive to being financially well as well. But my next question is for Mr. Rao. Is it important to be financially well to be emotionally well? And is there a single formula for achieving that financial well-being? What is the path to improve this kind of financial wellness?
I wish so. Thank you so much. And in fact, Dr. Kavita has given a wonderful example on that, and she spoke so well. It is true, emotions comes first to the finances. For emotion, because we are all emotional, and any decision will have a very different. Even in the risk-taking side, our ability to take the risk, good times and bad times, will undergo dramatic change. I think emotions play a very vital role. And having said, I think there is nothing called a single universal formula available or possible to derive what is that each of us can look at for the financial well-being. Because Amit and me, we were discussing with you sometime back in the last seminar, when we talk about the personal finance, the person comes before the finance. Means if the person is of the emotion and finance is a, like, it's different for each one of us. Now, four of us are sitting in the panel, and four of us will be behaving very differently for our own finances, given the situation of our life, our financial current status of finance, and current understanding of things, and we are emotionally very different. Of course, but there are some proven steps for to achieve financial being. But one need to work on it, and these steps is not applicable to everyone in the equal way. You need to look at each of us where we are. But end of it, financial well-being is something you need to look at. Is to key to control is to day-to-day finances, and whether as Dr. Kavita said, it is like managing your mind, managing your emotions. In fact, sometime back we used to run a workshop called "Master Your Mind and Manage Your Money." First, before you are managing your money, what you need to do is you need to master your mind. There is one thing we always used to emphasize is managing your money is like most important. And whether you are managing your money or money is managing you, that's where your emotions comes in when we are managing the money. And it's and end of it, all of us need to look at how my capacity to absorb all these financial risks, and for my emotions I am responsible. Means you need to take care of that first. And end of it, like these financial changes, unforeseen life events are happening at that time. How you manage your emotions first, then the finances comes later. I mean, any given circumstances, like there is some panicky report, something maybe I'm seeing in today's morning newspaper, then I may go and redeem. What is working is my emotions at that point of time. But if you can look at on the financial wellness, the 5 steps which I was talking about, is a predominantly like the first step. We always talk about financial literacy. The financial literacy is, this is for the financial well-being I'm talking about, not for the emotions. And one is the first is the financial literacy. This is basically when I'm starting investing, understanding the basics of the personal finance. I mean, I think this is the very big topic we can dwell little later. And the second one is the financial capability. Financial capability is, one is being knowledgeable and also capable to make better financial decisions. I am graduated to a level 2. And the third level is a financially secure. Financially secure is when your income is enough to cover your monthly expenses and your debt obligations well, and you have multiple income streams. Then you are financially secure. Your financial well-being at a level 3 level. And financial level 4 is you are financially independent. Financial independence is you are securing not only your assets, will be securing all your income streams, and your expenses, and your you are meeting all your expenses and future obligations. And the last step which we discussed last time was the financial freedom. That is financial well-being's the ultimate. I think it's a doctorate for all of us. I think it's like it's the where you have got substantial wealth, and here your wealth covers your lifestyle, your expenditure, and making money is not a priority for you, but living of your choice. And this is where the true financial well-being comes.
Right. So from meeting daily expenses in a proper way to being financially to attain financial freedom. So right. So but financial freedom can be obtained by investing right. So in that context, I come to Mr. Trivedi to invest right in this scenario of low interest rates. What are the options one can look at to create a corpus that can achieve financial freedom eventually and as soon as possible, of course?
Thanks, Vishav, and thanks, Mr. Rao, for this wonderful initiative of reaching out to people. Outlook Money is doing a commendable job in, trying to educate people, making them aware through such initiatives. And Vishav, a wonderful question that a lot of people are, concerned about these days, that interest rates have come down to such levels. What do we do? Now, financial freedom, because you mentioned that phrase in your question, I'm referring to financial freedom. It's a very vague term. And to that extent, a lot of people would not be able to see something which is that vague. And in that case, it's better to define that financial freedom by putting some amount, that this much should be even if I consider that as just a milestone and not the final destination, but having that amount in sight is always a better idea. So let's say somebody may say 1 crore, somebody may say 10 crores, somebody may say 2 crores, whatever could be the amount of 50 lakhs, depending on where one is. So that's my next milestone. And by when do I want to reach there? So this is, in other words, defining the financial goal. And as I said, it may not be the final goal, but it's a milestone. So this is step number one that one needs to start off. And that would set one on a path to planning for achieving that first goal. Number two, overall, if you see the goals, and this is one part of it. Second part of that is look at your own situation, your own requirements. What do you need money for? And that lists down your responsibilities and your dreams. Also, again, this is another term for financial goals. And how do you plan to achieve those? Now, I'll come to the low interest rate scenario in such case, because all these financial goals are to be adjusted for inflation. And whenever inflation moves down, interest rates move down. Both almost always move in a lockstep. So to that extent, the value of the goal also gets adjusted downwards when the interest income is also getting adjusted downwards. Now, once you calibrate both, then not much change is required to be done as far as the planning is concerned. The only caution that I would suggest out here is, and as both Mr. Rao and Kavita mentioned about the emotional aspect of it, whenever the interest rates go down, majority of us have a habit of only looking at the nominal rate of interest, which is without adjusting for the inflation. What we are supposed to look at is the real rate of interest, which is the rate of interest offered by various instruments minus the inflation. And that almost always remains in a very narrow range rather than fluctuating the way the interest rates are fluctuating. When we've seen interest rates as high as 10% a few years back, and today we are at around close to 5%. But if you look at the real rate of return, then it's remained around 1% or maybe 0.5%, not much of a difference there. And to that extent, that calibration doesn't require much, which means simply because interest rates have gone down, one should not start chasing risky investment avenues. A lot of people, when they chase those risky investments without understanding, eventually neither that higher interest rate nor the capital comes back. I would simply want to caution people against that.
Right. As you rightly pointed out, and other panelists have also pointed out, that emotions play a very important role in one's financial well-being, and even the way people invest their money and and all. So now in today's times, the year 2020 has shown us so many things that we had not even imagined, and this kind of a crisis often leads to some mistakes based on emotions that one must avoid, right? So my next question is for Professor Kavita. What are these common mistakes that one commits at these times, and how can they avoid them?
Okay, so let me try to answer this question, giving a background of how emotions are perceived. So there are two schools of thought over here. So one school of thought thinks that emotions are bad. Basically, because of emotions, we kind of make behavioral mistakes. And there is this other school of thought which thinks that emotions are good. Now, why are emotions good? Because when you are emotional, you tend to act, keeping aside whether the action is right or wrong. At least you tend to act rather than not act at all, right? And emotions actually drive you and basically make you focused. So sometimes, like how Amit sir was saying, that it is important to, to focus on details, right? Like for the example that he gave was on real interest rate and nominal interest rate. So emotions kind of tend you to train you to focus on details. So these are different schools of thought which says emotions are good or emotions are bad, right? Now, let me take the latter view that, for example, we say that emotions are bad. And let's look at some well-documented evidence out there. And why I say we have to look at well-documented evidence, because suppose you Google behavioral finance and you Google behavioral biases, you will come across some 600, 700 list of behavioral biases that is discussed out there. which basically means that it reduces every human being to irrational people. Like we are basically irrational and we don't make good decisions all the time. So that's why it's important to look at well documented behavioral biases, right? So the first classic example is that, think about it, like suppose people face gains and losses, right? So evidence suggests that people are risk averse in gains and they're risk seeking in losses. What does this mean? When you have a gain, you kind of sell off your gains faster and you hold on to your losses for longer, right? So if you look at this behavior, it's been proven that this behavior has not led to, wealth creation for people. So people stick on to their losses for long. Why do they stick on? Because of regret. They do not want to accept their losses. They believe that unless they square in their losses, they accept their losses, they are not theirs, right? But at the same time, when you get a gain, you kind of sell the gains very fast, right? So this behavior kind of comes from the fact that because losses hurt us 2 times much more than equal sized gains, right? But this is what psychology tells us. But this behavior, loss aversion, which we call it, which is a technical term, this has proven that people have lost their wealth because of loss aversion, right? So that's the first example. Second example, which is extremely classic, proven across naive investors, experts, everyone, is overconfidence. So let's keep aside finance for a while. So this is a very interesting experiment which was done in the US. So especially people were drivers, like people who drive on the road, they were asked this: do you think you are a better driver than an average person? And more than 70% of the responses came in that we are excellent drivers, we are much better than the average. So then what explains for all the road accidents that happens on the road, right? So this whole overconfidence, or what we call as misplaced confidence, right? It's proven even in financial markets. A very interesting study by Barber and Odin, which around 1980s, which proved that people who trade a lot, right? They do not create wealth, right? So they basically create lesser wealth than people who don't trade as much. And in fact, in that research, they have also proven that men trade much more than women in the financial markets. And, it kind of, if you compare men and women, probably, men would be perhaps making more losses, not because of financial literacy or anything, because of simply a behavior called trading, right? The third example which comes to me, and which I would say I'm also like plagued by that behavioral bias, is procrastination, right? And the whole idea is, let me put aside a thing, I will do it next week, let me exercise next week, let me start my SIP next week, all the time. So we are like human beings and we do this all the time, right? So these are some examples of biases, or we could say that we could become better by being aware of these biases. And there are various avenues now. So one is awareness that you're doing something wrong. The second is, there are many interventions which is provided by the government or by the state, right? So for the classic example for such an intervention is nudges. I don't know if you have heard of it, but nudging is very popular. It's a work that's come out of Richard Taylor and some of his colleagues. So these are kind of interventions which has helped people come across these behavioral biases, come away from these behavioral biases, and maybe improve their financial wealth.
Right. That's a great example of how people hold their losses for longer and sell off their gains sooner. And a lot of people may have committed these mistakes recently when markets were going through such volatility, due to COVID crisis, and the overconfidence. Of course, it's a major dampener when it comes to people creating wealth. So in times like this, there may also be a need for maybe taking a relook at one's financial goals. One cannot have the same financial goals and move in the same direction at the same pace when times are right, and when times are difficult, then one has to revisit them. So Mr. Rao, my question is for you: in such a scenario, how and whether one should actually revisit their goals, redefine them, and change their strategy of investment?
Yeah, I think thanks, Bishop, once again. I think I'll just start from where Dr. Kavita left. It's I fully agree on those emotions which were played very well, and most of us, there is something called on 2020 when it started. We started with a lot of optimism, and myself, Amit, and another friend of us, Harish, we were going across the country to talk to the people, creating something called 2020 vision, taking from the optometrist who will create your 20 by 20. This is a time you need to look at your vision very differently, and let us be very optimistic. This is just COVID started elsewhere in the world but not in India, and we were very, very positive and optimistic. And now situation is changed dramatically. In fact, yesterday I was reading an article. Now 2021 vision is, when I go to my optometrist, he will show to me the letters U, V, W, P, Q, R, S. That's in the order. Now we were asking whether market is upside, whether your recovery is economy is U or V or W, and our entire vision got understanding. It's changed, and people talk about now Q. It is, we do not know how it is happening, and there is another way, it's elephant. Yes, given the scenario, it is personal finance. I need to relook at, and whenever somebody thinks of relook, I always get this nice example which has comes from Albert Einstein. Albert Einstein was a professor in Princeton University in 1935 to 1950, I think. In 1948 and 1949, for his students, he set the question paper, the first year 1948 batch, and he would give the question paper. And then when they moved to second year, 1949, he gave the same question paper. And assistant of that Albert Einstein comes to him, Professor, there is something wrong. You have not seen these questions have already given to them. They know the answer. And shall I change it? And Albert Einstein replied to him, no, 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 don't change it. Questions remains the same, but answers have undergone dramatic change. And and when I look at 2019 and 2020, I think our emotions remains the same. Markets have undergone dramatic change, and I need to look at myself because it's a dramatic change. And earlier I am very optimistic, over bullish, earning more than what I need, and it is it's like this is a quote which comes from Will Smith, American actor. What he says is it's too many people spend money on they have not earned, and to buy things they don't want, and to impress people they don't like. And that was the situation for me in 2019. And 2020, I need to live for me. I need to live for the family, and I need to ensure that livelihood, and I need to take care of the society with charity, because if I'm having surplus, everyone got impacted, and we need to support. Given this uncertainty of the pandemic, yes, we need to relook. And earlier, I used to tell in the financial planning, start your long-term planning allocation first. Now have a vision for your long-term plan. When you want to retire, how you want to retire, fantastic. But work on the short term first, because your contingency comes the most priority. आने वाले 2 साल में मैं क्या करना चाहता हूँ. First 2 years के लिए you can make your budget. Then make your goal 2 to 5 years. You fund for it. After that you think of your long term. Means your entire strategy and allocation need to undergo change. Probably year beyond the emotions, you need to be the realistic, and you need to be the actual. I think that's where we need to work on it.
Right. That's a quite an insight. Emotions remain the same while markets have changed. So my question is for Mr. Trivedi. Markets have indeed changed. In March, when the markets tanked, the 5-year SIP returns were less than one would have earned even in bank deposits. How do you explain that? And now over the last 4-5 months, we have seen a surge in equity markets like never before. I can't say never before, but a tremendous surge. And when economic conditions have not improved that much. So how do you explain all these things? And do you feel that equity has failed over the long term to create long-term wealth?
So thanks, Isha. It's a wonderful question, and a lot of people are bothered about this right now because, 10 years long-term SIP equity, well-managed funds, fantastic fund managers, and still what I see in my account statement is less than what fixed deposit could have given to me. So why should I trust? Unfortunately, going by that, a lot of people have made a classical mistake of getting out of equity mutual funds and buying shares directly themselves without realizing that between a fund manager and myself, I'm still the amateur versus a professional. It's like when Roger Federer loses 2 matches, I can't go and play Wimbledon against him. That's the kind of behavior that people are witnessing. Now, coming back to the question whether equity markets have failed. No, equity markets have not really failed because let's understand that equity is a high risk investment avenue. And whenever there is a risk involved, the implied understanding should be that there is no there is no certainty. The uncertainty is extremely high, which means even for a long period, there is a possibility that one may earn low returns and sometimes even negative returns. Just go back a few decades, and between 1992 and 2002, over a 10-year period, Sensex delivered negative returns. So over a decade, it delivered negative returns, right? So that does happen every once in a while. It's just that the probability of such an event is low and extremely low. So does it mean that equities have failed? No, equities have played true to their nature. It is just that this turned out to be an unfortunate situation where a global pandemic, a once in a century kind of an event took place. And that event also happened when the overall economy was also not doing great. So when economy was not doing great and an external event happened, both combined together and they wiped out returns for maybe last 2 to 3 years in one stroke. Does it mean should I change my allocation? Well, looking at that fall, had somebody removed money from equity markets, the recovery that followed, one would have missed out on that recovery. And that again is another surprise that equity market keeps throwing. Is there a relation between economy and equity markets? I mean, almost never in the short term, but almost always over longer periods of time. So to that extent, if the economy continues to grow, equity markets are likely to grow in line with the broader economy.
Right. I just have a follow-up question.
Sure.
While those who invest in equity markets do expect some risk, but as you mentioned, a few months back, the markets corrected by almost 30-40%, right? And you mentioned that, it's a once a century kind of an event, but yet what would be your advice to equity investors at these volatile times?
Rao sir gave a beautiful analogy of the question paper was the same, but the answers changed. And the answers changed simply because the knowledge level of the students had changed. Okay, now it was, if you simply look at those students, then their knowledge level had changed. But if you look at the professor's knowledge had not changed as much as the students, simply because the professor had studied earlier and had studied whatever had happened earlier. So if simply one looks at what happened in 2020, that came as a big surprise, big shock. But if somebody who studies the history of markets, then in last 40 years, that is 1979, the base year of Sensex, till now, equity markets have fallen 7 times by more than 30% from the top. So this was the first time it happened for a lot of people who joined the market in last decade. But somebody who would at least studied, even if not being present, for that person, this was not a surprise. The other thing which also happened was in the last decade, 2010 to 19, the daily volatility had also muted significantly. The daily price movements had also muted significantly. And that got heightened in January, February, and March this year. And of course, subsequently, it's just continued. I'll come back to the same point which I made earlier. It is the very nature of equity markets to be highly volatile and uncertain. So to that extent, if you don't see that volatility, start thinking that there is something wrong going on. If you see heightened volatility, be comfortable. It is showing its true nature. And when it shows its true nature, the potential to deliver high return is also very high, because the high returns largely come because of those uncertainties and volatilities. If you expect flat returns, then you get fixed deposit kind of returns. So that's what I would say. So have faith, the faith in the Indian economy, the faith in the population, and we as a country has shown tremendous amount of resilience. And if that continues and the economy grows further, there will always be some episodes of temporary downturn turns or uncertainties, but otherwise I'm not really too much worried.
Right. As you said that, those who have been market for a long time, their reaction to these kind of volatility is different. And those who are veterans, those who are not veterans, who have not been in the market for a long time, they react differently. So Professor Kavita, I want to ask you, what do you think of, people's understanding of investment risks, be it veterans or be it the newbies? Are people in general able to clearly evaluate the risk while taking investment decisions?
Okay, so let me basically start with an example. Again, a bit away from finance. So this was a question that was posed to Europeans and Americans, and this question was: so suppose the weather department tells you that there is a 5% chance of rain, and how do you think people will interpret it? Okay, so people in Berlin were asked this question, and so Gerd Gigerenzer, who's a very famous psychologist, basically ran this experiment. So some people came and said that, 5% of the region will get rain, 5% of the time it will rain today. Uh, Apparently, there was also another person who said that 5% of the clouds seem to be, cloud bearing, like rain bearing clouds, and they will rain, right? So in the New York, the response was largely about that 5% of the time it is going to rain. So if you extrapolate this example to financial markets, and if you simply open a mutual fund brochure, right? So what is the kind of statistics that you find there, especially risk statistics, right? So if you look at a mutual fund brochure, you will see that there is average return, there is standard deviation, which is basically a classic measure of risk. That is what we have been taught. There is something called Sharpe's ratio. It goes on, information ratio, Sortino ratio, blah, 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 right? So all of this means that how do people basically understand risks, the way risks are communicated, and whether investors, first of all, understand basic risks the way they're communicated. Do people understand when you say 5% chance? Do people understand it better than if you say 5 out of 100 times, 50 out of 1,000 times, 500 out of 10,000 times, right? So risk communication becomes extremely important when you are, basic trying to understand how people understand investment risks, right? So I would say that the first thing is about risk literacy. And this is an important question which the industry needs to ask, because industry communicates these risks to investors, right? So industry first needs to ask, how should risks be communicated so that so that investors, whether it is naive investors or experts, whether they understand the way industry wants them to understand risks. That's one. Second is, like the previous example which I gave, one needs to understand the psychology behind risks. So imagine, you're telling your client that your client comes to you and says that I want to develop a portfolio. I want to develop an investment portfolio to basically, to create wealth for my daughter's wedding. Another client comes and tells you that I want to create an investment portfolio because I want to go on this lavish, world tour, right? But the kind of risk that this client is willing to take to create an investment portfolio to fund his or her daughter's wedding will be very different than the kind of risk that the client is willing to take to fund a vacation. Why? Because there is psychology of risk, right? So there is a much more emotional attachment to the portfolio that you want to create for your daughter's wedding, vis-a-vis if you want to take a lavish vacation, right? So I think there is much work to be done to understand the psychology behind these risks. And going back to both, what Mr. Rao and Mr. Amit was saying, that so suppose somebody started investing in the financial markets, say in 2002, and they looked at their portfolio, this April or this May, where everything was in red, the way they would react to it would be very different than somebody who started their portfolio, say in 2019, and started looking at their portfolio, which is red, right? So what we call in psychology as the recency effect, right? That kind of impacts the way we, try and understand about risks.
Right. Thank you for these wonderful insights. I think this would really help our viewers. We have been talking about emotional and financial well-being throughout this conversation. I want to take a step back and, again go back to what has happened during COVID and how it has affected people's financial well-being. A lot of people have faced salary cuts. A lot of people have faced job losses, or just losses in investments, like Professor Kavita was mentioning, that somebody whom have started their journey in 2009, the investment journey in 2019, and had seen that 30, 40, 50% losses in the portfolio. Now that has to that is bound to affect the emotional well-being of that person. So I want to ask both you and Mr. Trivedi, how can one maintain their emotional well-being at such times?
Okay. Shall I take it first?
Yes, sir, please.
Okay, I think this pandemic has created definitely a lot of chaos to us, and every one of us need to evaluate our priorities and to handle at this point of time. I personally feel we need to go back to the basics, and this lockdown has helped us to live more frugally. For example, like if I'm spending 100 rupees earlier, in the last 6 months I would have spent 60 rupees, and today, like last 6 months, in my 25 years of career, my credit card bill is zero. Then there are some positivities and there are some negatives. And how I need to look at and get my financial well-being is, it is a time for me to reconnect with my money very differently, and to take control of my finances. And to taking control of the finances, the way one is, what is my earning now and how I am my future earning, how it looks at the first thing. And second one is how I can what is the way I spend, understanding my own spending. That's the second parameter to look at. Third is I can audit all my finances at this point of time. We know, as at a company audit, we audit all the things every year, every quarter. How many times we audit our own finances? In fact, we created one wonderful book where you can keep writing of you can just because we are into the system, but is it better you can write down, and so that you can think very differently. I am a brain based coach, and where you are when you are writing down, you think very differently on things, or when you are seeing on your system or on the Excel sheet. It's and like this is one you can look at. I think we'll share this link available to the audience. They can pre-download this book, and they can do. And after auditing your finances, what you need to do is, I think Kavita said about emotions, how you spend in your emotions. Even you need to audit your emotions. In fact, in the coaching, I keep telling the clients, my coaches, how you write your journal. In the journal, you are writing, you're typically you're watching how your emotions are there during different times, so that tomorrow I am getting prepared for things. Third is, last one is, now you need to the time for us to determine your needs and wants. Now we are having a perfect clarity in the last 180 days between discretionary spend and non-discretionary spend. And if you can do that audit, and spend time with a family to check with your finances, because finance impacting the entire family, not one individual. It's a family financial decisions, and allocate money according to the goals. Combinedly, you come back, and this will reduce your money stress, and this will increase your happiness quotient on the way you invest your money. Even sometimes you may feel like the little I have, but more I have to spend now. That's an opportunity. I think I'll leave to Amit here to take the technical aspect of the.
Yeah, so sure. Thanks, sir. You covered it beautifully well on the and in, to great extent on the emotional side or the behavior side, and how do we look at finances. I would actually take an example from sports, and let's take any competitive sport, whether it is tennis or football or cricket or whatever it is. But the winner wins because the winner scores more than the person who loses. And just look at it, the finances in the same manner, that the winner does not win by only scoring. One has to also protect. So let's say a football game, the team that scores 3 goals can also lose if the opponent scores 4. And these 4 goals which the opponents have scored are your expenses, and the 3 goals that you scored is your income. How do you play the game of life, and how do you win the game of life, is by scoring more continuously than what you are spending. Now, this is a big lesson that has come to us. And in order to save properly, which means you are not spending too much or you are not allowing the opponent to score too many goals, your defense must be very, very strong. Now, this defense is what Mr. Rao was talking about, where you do the audit of your emotions and you do audit of your own finances. Are you spending at the right place? Are you spending the right amounts, or are you a bit more reckless? And that recklessness often comes from one of the emotions that Kavita mentioned about the drivers. Oh, I have the ability to earn more than the others. I don't bother about my expenses because I can cover it up through my income. And often it doesn't happen, because a pandemic like this also taught us the lesson that people who are actually high flying, and this is not, no pun intended, but many high flying jobs and high flying careers, they were more affected as compared to some of the more mundane jobs. On the other end, there were some mundane jobs which also got very badly affected. So it's not spared anybody in a particular manner. Who spared? The people who had stronger defense when it came to their expenses, and the people who were reasonably well. So even if I can save a few more goals, if I score one less goal, I'll still be able to win my match. So what I would say very quickly now is, keep an eye on the expenses. Keep a contingency fund or an emergency fund which takes care of some months. So maybe 3 months, 6 months, 1 year, depending on how vulnerable you think your income is. Number one. Number two, from that emergency fund, the next step is to have some sort of risk cover, which is where insurance comes in. It could be health insurance, it would be life insurance, etc., etc. So contingency fund, insurance, and after that, you start looking at what are the loans that you need to service. And then comes the question of your short-term, medium-term, and long-term goals. Once you looked at everything in this manner, in this particular form, then things start becoming relatively easier for one to manage, because then you can actually decide that out of the goals that you've listed, which goals are important and critical and which goals are good to have. Kavita gave a beautiful example of, the daughter's wedding. I would actually say daughter's education. Yeah, and far more important goal, or my retirement, far more important goal than having that vacation. And I believe in 2021 they are starting a bus service from Delhi to London. So somebody may be planning for that. But if you can't do that bus service, bus journey, it's okay. What you want to fund is your daughter's education first. So important goals and less important goals. And then out of the important goals, you divide those goals in terms of which are more urgent and which are far in future. Once you start that approach, then planning becomes a lot more easier. That's how I would put it, in a simple ways.
Right. So basically, you talk about two kinds of goals. One, the goals in football, and the ones that are the financial goals. And you talked about prioritizing the financial goals, right?
Yes.
And always having more goals in attack, against your opponent, actually.
Yeah.
Right. So now my question is, what if there is someone, a wealthy individual who can score as many goals, who can fund as many financial goals as possible, and how should they look at investing their money in these times?
Fantastic question, Vishav. And a lot of people come with this kind of an argument that I've got more than enough. Now, if it really is more than enough, and I was just reading the other day a book by Joseph Heller, the book's title is Enough. Okay. Sorry, I forgot the name of the author, but he quoted this book by Joseph Heller called Catch 22. So the book Enough starts with a conversation between Joseph Heller and somebody. And somebody tells Joseph Heller, referring to one hedge fund manager, that this guy has got more, he makes more money every year than the amount of money that you earned by selling this bestseller called Catch 22, one single book. Okay. So Joseph Heller gives us a smile and says, yeah, but still he doesn't have what I have. And this guy was shocked. What is it that you have and this guy doesn't have? He said, enough. I have enough. He doesn't have. Now, when you are wealthy enough, how do you define that wealth? is very important. The wealth should be able to fund all your life's expenses, including the financial goals, without the need to work. Then you are a wealthy individual. Yeah. But then comes the responsibility. If I'm wealthy enough, will I be able to provide enough for my next generation? And if I am able to do that, then as Mr. Rao mentioned some time back, can I do some charitable activities? Now, see, my goals are funded. I'll simply add my next generation's goal, or what I want to live, what I want to leave for my next generation, and what I want to leave for charitable causes. The moment I start defining those goals, then goal-based planning becomes easier. No, these are also good to have goals, which means it gives me a little bit of flexibility. But without deciding on the destination, it's a very, very scary situation. You know, just yesterday I was reading one articles that people are so fed up of staying at home that some of the airlines have started a service called Flight to Nowhere. So you board the flight, they move around in the sky for a couple of hours and then put you back in the same airport. And for that, the airlines are charging and people are spending money. It only reminded me of a lot of investors who invest in that manner. They invest their money when they don't want to go anywhere. So they take a round, come back, airlines makes money. So all the financial intermediaries will make money and the person would not enjoy at all. So even if you are wealthy, and even if you've got more wealth to offer to people, decide whom do you want to offer to. Don't let somebody else take the wrong advantage of that. That's what I would say.
Right. Again, a great analogy, which I really enjoyed, listening to, and I'm sure I will be using it to explain,
Sure.
finances to my friends
Sure.
and colleagues. Mr. Rao, I have one more question for you. I want to ask you, again, a lot of people that I know also, and, a lot of people who invest their money now during these times, a lot of them are forced to pause their SIPs because of financial crunch due to some reason or the other. So, Mr. Rao, what would be the impact of pausing that SIP on their long-term finances, and what is your advice to these kind of investors?
Visham, I think it's most of the people out of panic they would have closed, and also out of necessity they have closed some SIPs in the month of March. And the predominantly when we did a research, it looks like people out of panic you were closed. Panic is that markets are going to fall more, or second is there is an uncertainty of how I can fund. But if you have a right financial advisor at that point of time, I think he would have he or she would have sat with you, sat with the person and said, what are the priorities, what to close and what not to close. Having closed for the last 6 months, I think there is an opportunity when, getting the units allotted the less and going up. That will definitely have some impact. But having taken this decision, it is now is what is the corrective decision we can look at. I think I'll quote here the Peter Drucker on the management, which is more relevant here. Peter Drucker always used to say the greatest danger of the turbulence is not in the turbulence, but the way you look at the turbulence with the old logic. And you need to have one. And at this point of time, my pandemic will end. Maybe beginning of the end is already started, and time to relook. I think, as Amit said, how you need to prioritize your goals and get back where you can restart your SIPs. And that's a better way to rebuild your goals and relooking at your SIPs. Probably, I was telling earlier, the frugal living. Currently, if I am living at 70% of my income, because of the pandemic, I know how to save now. I think today is the 180th day I am sitting at home. Every year, a year before, I took 180 flights across the country. And it's I think now flying nowhere, as Amit's example, which I take it. And now you have a lot of money to save. Probably that you convert. If not an SIP, you can you can do a step up SIP, or you allocate that money to reallocate for the short term. You can allocate in the next 6 months money to the markets, and if you can look at whichever the Indian economy is looking at, whether U, V, W, Q or elephant, whichever the curve it is opening, but everyone came to one logic: by 2022 Indian economy will be back to there. By the time, are you funded full and then get exploited, explore that all the possibilities of making money.
Right. I think we are almost out of time. So before we close, I will ask one question to each of you. What is one lesson that people should take away from this conversation? I put this question to Professor Kavita first. I'd request you to keep it short because we have paucity of time.
Okay, so let me close with just one quote by Adam Smith, which he said in the Money Game when he wrote the book, and the quote is basically, we are a bunch of emotions, we are a bunch of prejudices, we have all kind of issues. There's no problem with it as far as you are aware of it. So, basically what Outlook and what Aditya Birla Group is doing is creating awareness, whether it is about financial literacy, whether it is about emotional well-being. And I think that's the first step. We have to be aware to take action.
Right. Mr. Rao?
I think so. It's to put it short. I look at today as a financial well-being when we're talking, and financial well-being is a state of well-being which is measured by quality of your life, but not by just wealth. I think having said that, never forget your SIP. SIP is a systematic investment plan in normal mutual fund parlance, but for me, SIP is little beyond. That is, save wisely, invest rightly, and plan smartly, and that will give another SIP to you in your life, that is save, invest and prosper, and create healthier and happier relations with money so that you can have your emotional well-being and financial well-being.
Right. Mr. Trivedi, you have, can you add one more point to that?
Yeah. So my sense would be a lot of times people look at money as something very important, but let's understand the role of money. Money is a means to an end and not an end in itself. And that end really is the life that I want to live, the life of my choice that I want to live. And for that purpose, I need money, and for that purpose, I need to plan my finances. So always keep that life at the focus and not money. Money is required, it is very important, but much more important is life, and that's where that holistic well-being that Mr. Rao and Kavita also explained earlier comes into picture. Keep that holistic well-being in mind. It's about your life.
All right. Thank you so much, everyone, for your time. It was a really interesting and insightful conversation, and I personally enjoyed it a lot because it had a balance of financial advice and life advice. And I'm sure our viewers would also find a lot of valuable inputs from take a lot of valuable inputs from this conversation, and this advice would help them not only be financially well but also being emotionally well at the same time. So I think it's a holistic conversation that we had, and we would like to have many more such conversations. And I would request all our viewers to be back for our next webinar. Till then, see you, and let's just meet then and sign off. Thank you so much.
Thank you.
Thank you so much.
Stay safe.